Hi, I'm Paul Feinberg, the editor of Anderson Assets at the UCLA Anderson School, and I'm here today with Professor Brett Trueman, Professor of Accounting. Professor, stock analysts have been in the news a lot lately, and I understand you've done a lot of work and research on stock analysts. Can you tell us a bit about it?
Along with a few colleagues, I've done some work over the last few years looking at the profitability of security analyst stock recommendations. And what we found was that for the last 16 or so years, taken as a whole, the recommendations of security analysts actually were profitable in that the stocks that they recommended as buys went up, while the stocks they recommended to be sold actually went down. So if you would have listened to the security analysts, you would have done well in the sense that the stocks you bought would have outperformed those that you might have sold according to the analyst recommendations.
It's interesting to hear you say that the advice of the analysts has been as profitable as you say. Is that true even in a case of a year like 2000 when they were getting under such scrutiny?
It's interesting what happened in the years 2000 and 2001. As you know, the market topped in March or so of 2000 and then began a steady and sharp decline. And it was during that period that you heard a lot of media criticizing analysts and regulators investigating analysts. So yes, the years 2000, 2001 are of particular importance, and we focused on those years in our research. And what we found was that while their buy recommendations went down in price, when you compared how those recommendations performed to a particular benchmark of stocks that they were choosing from, those buy recommendations actually did better relative to those other stocks. So their buy recommendations actually went up relative to their benchmark. And their sell recommendations, it's true that the stocks they recommended be sold went up in price, well, relative to the stocks that they were thinking of recommending sells for, their sell recommendations actually did worse than the average stock that they were looking at. In other words, analysts typically tend to put buy recommendations on stocks that are growth stocks, that are growing quickly in terms of sales or earnings, and their buy recommendations did better than the average growth stock, while analysts tend to pan value stocks, that is, stocks whose earnings or sales are not growing fast or might actually be declining. Well, their sell recommendations actually did worse than the average value stock out there in the marketplace. So yes, their buy recommendations in 2000 absolutely did bad because growth stocks in general were out of favor. But they were able to pick the relatively good growth stocks, the ones that didn't do as badly. And value stocks were in favor in the years 2000 and 2001. And so they went up in general. But the ones that the analysts chose to focus on and recommend sell, those did worse than the average value stock. So overall, we concluded that yes, the analysts did have value even in 2000 and 2001, and that relative to their benchmarks, the stocks they recommended as buys went up or outperformed, and the stocks they recommended as sells underperformed.
Well, in light of that, are you saying that there really was no need for this type of scrutiny either from the media or the government?
No, not at all. Even if analysts are doing a great job, even if their recommendations actually are profitable, investors clearly had questions about the quality of analysts' recommendations, just as they clearly had questions about the quality of corporate earnings reports. And with the crisis of confidence that occurred in the early 2000s, it was important for regulations to come into play in order to restore investor confidence. After all, the prime function of the capital markets is to allow corporations to raise capital in order to maintain their operations and grow. If investors do not have confidence in the capital markets, they're not going to be willing to pay as much for the shares and the debt that's issued by corporations. So to whatever extent we can restore investor confidence in the markets, whether through regulations on the accounting of corporations or regulations to ensure that investors have more confidence in analyst research, whatever it takes, we need to do it so that the capital markets continue to serve their role as a medium for corporations to raise funds.
You've talked about what happens when investors lose confidence in some of the analysts and their research. What things can investors do to learn about stocks and investments outside of going to the analysts?
Well, there's a tremendous amount of information available to the public about corporate financial health. In particular, companies have to disclose every 3 months results of their operations for the last quarter. The reports that they issue quarterly are called 10Q reports, and they're issued to the Securities and Exchange Commission. And at the end of the year, they have to issue an annual report, which is called 10K, to the Securities and Exchange Commission. There's a tremendous amount of information there, both in the financial statements and the accompanying footnotes, for investors to use to try to determine whether or not the stocks they're considering buying are really good deals. The problem, though, for many investors is that it's quite difficult for the layperson to really understand in great detail the information that's put out to the SEC by the corporations. So what I normally tell investors is that if they are thinking of buying stocks, individual stocks rather than investing in mutual funds or exchange-traded funds, I would suggest that they only invest in individual stocks if they have enough knowledge to be able to read the financial statements and accompanying footnotes and to be able to appropriately act based on that information. If they have very little accounting background, I think it's going to be very difficult for them to really appreciate the information that's disseminated publicly by these corporations to the SEC. And as a result, I would tend to tell these investors that they might want to look toward a mutual fund that would do the investing for them and the research for them instead of relying on their own research into these companies.
You mentioned that it's important for investors to have a good understanding of accounting, to understand the financial ledgers and the information being put out by different companies. Can you elaborate a bit on that and tell us why that's so?
Sure. All corporations have to abide by generally accepted accounting principles in the United States when they issue financial reports. These principles are actually just that, principles. In other words, they are broad guidelines in many cases rather than specific statements about exactly what numbers need to be reported on the financial statements. That means that managers do have some flexibility with respect to the numbers that get reported on the financial statements. So it's important for investors to understand the accounting rules for the accounting for various aspects of operations, as well as the leeway that management has within those rules. Going further, they need to understand the extent to which management might be able to paint a rosier picture of the company's financial health than might otherwise be warranted. And there are many ways in which managers could present a rosier picture. They could try to recognize revenue, for example, more quickly in time. They might attempt to show less debt on the balance sheet, making them look less debt-heavy, less risky. For investors to be able to spot whether managers are being aggressive in the way that they're portraying a company's financial health, they need to understand where and to what extent managers do have that leeway to present the financial statements in a rosier light. And that's something that investors can find out by looking at the footnotes of the financial statements. But again, those footnotes are written in a way that is not readily understandable completely to the novice investor, but rather are geared to someone really who knows some accounting, can really understand what's being said. Even then, it can sometimes be quite difficult to understand the financial statements. If you take as an example Enron, it was very clear that Enron's statements were anything but clear, in that reading the financial statements, it was very difficult at times to understand exactly what Enron was doing. If companies do want to hide things, there are ways that they can go to make it more difficult for investors to see what's actually going on.